Hello, everyone, and welcome to our monthly investment insights for the month of October. My name is Alexandra Shepis. I'm a lead advisor here at Francis Financial. Today, we will take a look back at what happened during September in the markets and also give our thoughts on the outlook ahead. So with that, let's jump right in. September has historically been the worst month of the year for the equity market, and this year was no exception. The S&P 500 was down 4.8% for the month and 3.3% for the third quarter. Bonds struggled as well, losing 2.5% for the month, bringing their quarterly loss to 3.2%. This combination on both the bond side and the stock side led to a decline of a little bit over 3% for the quarter for a balanced portfolio invested in 60% stocks, 40% bonds. Now, it's important to note that most asset classes, except for bonds, still have really solid year-to-date returns, with the balanced portfolio up over 5% for the year and U.S. large cap stocks up over 13%. The fourth quarter has historically been a strong one for equity markets, with the Fed likely near the end of the rate hiking cycle. If they aren't there already, the possibility exists for a strong finish to the year. In the third quarter, bond yields were the story. The yield on the 10-year Treasury bond moved up from 3.8% to start the quarter to 4.6% to finish. This is the highest level on the 10-year dating back to 2007, a 16-year high. Now, this pretty dramatic rate increase led to a decline in stocks for two reasons. First, future cash flows from stocks are worth less today when rates are higher. And second, after years of there is no alternative to stocks, there now is an alternative to stocks with ultra-safe short-term Treasury bonds and CDs now paying over 5.5%. The sharp increase in rates negatively impacted both stocks and bonds. However, the decline was orderly, and we view it as a period of positive retrenchment, building the base for the next upswing of the market. Most investors and Fed officials think the rate increase cycle is nearly done, with possibly one more 0.25% or 25 basis point rate hike during the fourth quarter. The consensus opinion is for rates to then start declining in 2024. Following a final Federal Reserve hike the last 4 cycles, returns have been strong for all asset classes. Stocks have averaged a 1-year return of 16%, bonds over 10%, and a balanced portfolio has returned 14%. The laggard has been the safe cash investment, which looks attractive now with yields over 5%, but this yield does drop rapidly once rate cuts begin. It's important to note that despite the challenging third quarter, if the end of the rate cycle is near, there is reason for optimism in the markets. Thank you so much for tuning into our monthly investment insights. Feel free to reach out to us with any questions you might have. Thank you.